it's so fascinating to me, the disconnect between a stock like Meta, how we expect it to behave, but versus how it actually behaves. For the average person who's going in and investing in Meta, you're really not expecting 5% moves up or down in a single day, right? But it happens all the time. Greetings, DR.
Richard, it's good to get together once again for Market Moves. How are you doing this week?
I'm doing great, thanks. Excited about this big breakout that we're having. I think happy days are here again. All our troubles are in the past. It looks like the stock market's just fine and everything's going to be rosy.
Well,
so excited.
You know what? The fear of missing out is a powerful motivator, my good friend.
Oh boy, is it. Oh boy, is it. Sure is.
Yeah.
Great. Well, let's hey, what's been happening this week?
Well, there's been some interesting things. I think, of course, as you're talking about the breakout, we've got new inflationary news that people like, so that's helping out. But I think there's I'd like to talk about one of the big items that came out that wasn't a market mover, but that was a generational mover. I'd love to talk with you about the passing of a legend of Dr. Harry Markowitz.
He had definitely introduced us to the idea of risk-adjusted returns, right? And to the idea that investing is really a trade-off between risk and reward, right? And look, there's a lot of skepticism about modern portfolio in the markets today from very successful and thoughtful people. I remember one gentleman saying to me recently, I've never actually seen an efficient frontier. And look, we're getting into the weeds here a little bit, but there are legitimate questions. But I really think that Markowitz's work has a relevance for our digital age that isn't fully appreciated yet. So I see this, the metaverse, the internet, whatever you want to call it, this digital world that we're living in now as essentially being a bunch of digital signals. And how do we kind of pick out a collection of those digital signals or digital assets, for example, and braid them together in a way that works for our own risk tolerances and gives us, the trajectory that we're looking for. So I think Markowitz's work is going to be not reappreciated. Obviously, he's much recognized and appreciated, and he got the Nobel Prize. But I think in the digital world, it's going to become increasingly consequential, and people are going to realize that Markowitz is far from being put into the dustbin of history, if you will. So it definitely was the passing of a legend. I remember one of my favorite pieces I wrote was after the those Super Bowl commercials, crypto commercials, just awful things, and I contrasted that with true financial innovation, which was the work of Harry Markowitz. So definitely the passing of a legend, and I think his legend is only set to grow.
Wow, strong endorsement indeed, and I think things like the efficient market hypothesis and things like that you mentioned, Richard, that they have been. I don't think his modern portfolio theory was based on that. And a lot of the stuff that you do and that we work on is on postmodern portfolio theory, still some of the same, many of the same concepts. But the fact that he published the original paper in 1952, I think, and we're still talking about it today, shows what kind of staying power his thinking had.
70 years ago.
Wow.
Amazing.
Yeah, indeed. Well, let's put some of those thoughts to work and take a look at a couple of the things that I've been looking at and tossing over to you during the week, and talk about how some of those correlation and diversification thoughts can play out in a portfolio. Let's look first at a stock that a lot of people have been talking about lately because of the way this thing has been zooming up the chart this year. What I noticed here was all of these resistance level that we've been getting in Meta. I think it's breaking out a little bit today, finally, but that we've been seeing it knock up for like 8-10 days against this same resistance level from a big gap, a big, huge gap here. And there's a, you see this thing has lots of gaps all over the place. There's one, that all of these gaps are there. And that says to me, well, maybe this stock's a little more bouncy, a little more volatile than most. And so I pulled up a chart that you've been working on, Richard, and I will show that. Then we can come back if you'd like. But this chart of Meta on a histogram, whoa, it is very volatile. It's got huge
and
tails.
again, to remind people, what is this? This is showing over the course of a year how many times the daily gain falls into one of these buckets, percentage gain. So is it plus 1% or minus 1%, plus 2% or minus 2%, plus 5% or more, or minus 5% or more? And I think, we have this idea Meta is a mega cap stock, right?
Yeah.
And that mega cap stocks, they used to be really stable and they used to be normally distributed like a bell curve, right? We got the nice shape, very little in the tails over here at the ends and nice big crest in the middle like a bell. But that's not what we have in Meta at all. And I think it's so fascinating to me, the disconnect between what we sort of expect a stock like Meta, how we expect it to behave, but versus how it actually behaves. Meta is a very volatile stock. Those are some fat tails there at plus or minus 5%, meaning regularly has daily moves of 5% or more up or down, right? And for the average person who's going in and investing in Meta, you're really not expecting 5% moves up or down in a single day, right? But it happens all the time. And it's same with a lot of the other big tech, mega cap stocks. And I think that's really a new thing. I think it's kind of a psychological operation. And, which brings me back to Markowitz for a minute. I think that Markowitz really has more relevance to behavioral finance than people really appreciate. We've got to get our return distributions. We've got to get our volatility to within a range that works for our own psychology. And when you get outside of that range, because you haven't looked at the math, you don't know what your expectation should be, but you have expectations, right? So you've got expectations, but they're not really grounded in history and reality. And it's when we get a disconnect between our mental expectations and market reality that we get disoriented, and then we end up making inefficient decisions. So, my efficient market hypothesis is that once you get into your own kind of risk comfort zone, you make more efficient decisions. Okay. And you're less likely to make inefficient decisions. So maybe we can put that forward as a new efficient market hypothesis.
Is your need to be efficient. And I think following up on that, Richard, this chart shows the correlation history of Meta to the S&P 500.
Well, let's just explain what this is first, DR. So what are we looking at here?
So we're looking at this is just a single line that shows the correlation coefficient between Meta, the stock, and the S&P 500, represented here by SPY ETF. And that correlation coefficient just says when SPY moves up, does Meta also move up, or does it move down when S&P moves down, or does it? Or are they not related at all? Are they not correlated at all? Does when one move one way, it doesn't matter, and the other one does its own thing? And so you get.
And this is
Go ahead, Richard.
over a 1 year
A 1 year
period, right?
period.
So
Yep.
it's like a rolling 1 year average of Meta's correlation to the S&P 500. So what we're seeing here, you think that Meta would be highly correlated to the S&P 500 up there near 1. And a lot of times it is between 0.8 and 1. 1 is maximum correlation. But there are times when Meta just completely falls out of bed with the S&P 500. And even back in 2016 was negatively correlated to the S&P 500. So when the S&P 500 would go up, Meta would go down and vice versa. So it's very interesting when we do see these periods of, the correlation really going to zero between Meta and the S&P 500. And I think those, again, it's not what we expect, right? And so we have to be able to look at market history, look at market data, and let the markets tell us what the expectations actually are, right? Instead of letting the media tell us what our expectations should be, or having these vague expectations that we haven't really examined or interrogated. And that's why I find this way of looking at the markets to be so helpful and interesting, right?
Right. I think the other very useful thing about this, Richard, looking at a chart like this, is that even if you are a firm believer in a diversified portfolio, that just because your portfolio is diversified today doesn't mean that it'll be diversified in a few months. The markets and individual
Yep,
stocks in particular, they change. They change and their relationships
absolutely.
change.
Great point. And diversification is something that has to be monitored and managed. It's not like a set it and forget it thing.
Perfect way to think
So,
about it. Yeah, I
yep,
love that thought. Well, let's look at
yep.
one other stock really quickly because I think there's something interesting going on. That in the against the broader market, the S&P 500, Amazon right now is one of those stocks that's not very correlated, and I am not talking about a an investment thought here or strategy, but just to point out that while some stocks and most of these mega caps we think of again as the market's just moving with them, right now it's not the case for each one of them, and that takes me to the next chart. Unless you want to chime in on that
So
right there,
just
Richard.
again,
Yeah,
this is a different platform. This is stock charts, I
yes, it
guess,
is.
but we're looking at the rolling 1 year correlation between Amazon and the S&P 500 at this point.
Yep.
It does spend a lot of time near 1, but currently, it's fallen out of correlation with the S&P 500 and now it's down around 34%, which isn't as high as you'd expect. So Amazon is somewhat uncorrelated to the S&P 500 right now and could be a good source of diversification for some portfolios.
Yeah, which takes us to the to looking at all of the megatechs. That I thought this was very interesting, both from the correlation perspective, which we'll talk about. But this chart comes from your work, Richard, from Finiac, and it pulled it out this morning. And it shows. I wanted to talk about the histograms, but then we can look at some other correlations, especially relative to the QQQ, to the NASDAQ in this case. But
Mm-hmm.
I thought that when I first looked at this week, I said, wow, the megatech stocks don't act at all like each other. The big seven don't act at all like
Mm-hmm.
each other when we look at them and their
Right.
histograms.
Yep. So I love this view. I love just glancing at a histogram as an indicator about the stock. you can see here, Apple and Microsoft are calm, relatively speaking. Tesla and Nvidia, and to a lesser degree, Meta are nuts. I mean, look at Tesla. The biggest moves are plus or minus 5% on any given day. That's crazy for a stock the size of Tesla to be having plus or minus 5% moves. And if you're not expecting that because you think Tesla is somehow, a big stable stock, you're going to get in trouble. So Nvidia, very volatile as well. So yes, great view. And these correlations here that we're looking at are relative to the QQQ, right? So it's interesting that they're not as highly correlated to the cubes as you might think.
They're way,
Which
and
probably doesn't
yeah,
say much for the smaller cap technology stocks haven't been enjoying the same um, uh, yellow brick road as these mega cap tech stocks.
that's very true. And the thing that I really like in looking at this is that if you want to take a stock in because you want the performance, you've got to be willing to live with some real volatile, jolty up and down times, unless you know the characteristic of the stock.
And you need to think about how it fits in your portfolio as a whole. So if you're looking at these opportunities and you were looking at this relative to your portfolio at a whole, you'd want to choose one of them that was less correlated to your existing portfolio to give your overall portfolio a smoother experience for you and to work within your behavioral tolerances. I was reminded of how much I dislike Silicon Valley this week when that Wall Street Journal piece came out on how the use of drugs and psychedelics is like considered an acceptable thing.
Yeah.
It just reminded me how these technology companies, they're always looking to kind of cheat in a way, and that technology is somehow always the answer, that you can always get through life by substituting technology for doing the hard work or having great relationships, etc. So I just think this is a culture that is not ultimately going to end up where it claims it's going to end up. And I think we saw that again this week with the revelations of widespread psychedelic use amongst technology executives. I don't think that's a good trend. And to me, it's another reason to look for some other opportunities, And on that note, DR, I have one thing that I'd like to share briefly. I thought this was a fantastic piece from one of my favorite writers today, Ted Gioia, who has a Substack called The Honest Broker, wrote this fantastic piece, 30 Signs You Are Living in an Information Crap Apocalypse. The age of information has come to a brutal end. Here's how it happened. And I just really would recommend people take a look at this because it tells you exactly what's going on. People keep telling me we're living in an information superhighway, but that's not true. The flow of information today is more like a river, a very polluted river. Folks have been dumping their crap into our information flows for a long, long time. Big corporations and institutions are the worst offenders. They actually get rich by polluting our data streams, but individuals are adding to the raw sewage too. And, then he goes through and lists 30 things that are going on. The result is a crisis of trust, unlike anything seen before in modern history. We can't trust information anymore. And these big technology companies are some of the worst offenders, right? Look, here's 30 signs you're living in an information crap apocalypse. 1, create a society that rewards influencers more than truth tellers. and turn every digital platform, large or small, into a boosting pad for these influencers.
Wow.
I mean, is that not what's going on, right? So this is not a sustainable culture, and we absolutely need to be investing in alternatives to a society that just rewards influencers more than truth tellers and turns every digital platform, large or small, into a boosting pad for these influencers, and that just makes money off of the algorithms. It's not going to get us where we ultimately want to be. So some food for thought as we head into the 4th of July weekend.
Wow.
I hope everybody has a great 4th of July.
That,
Yes, may Professor Markowitz rest in peace. I think he made great contributions. I think his work will continue to be appreciated and recognized over time. And I think that the main thing people need to take away is that you can build your own portfolio tuned to your risk tolerances while still, optimizing your chances for success.
wow. A great wrap up, Richard, and some strong thoughts as we head into a weekend celebrating freedom. I love those thoughts,
Yeah,
and
it's a serious thing.
we'll look forward to seeing you on the other side of a long weekend.
Yep. Have a great 4th, everybody. You too, DR. See you next week.